Hello. Welcome to another video from 10x Investor Education. In this video, I would like to talk about SPACs, three Ds of SPACs, okay? De-Spac process, dilution, and dumping. So why a lot of these SPACs becoming penny stocks? Okay, this is very important. Some of you own a lot of these SPACs. Okay, I myself own a lot of these SPACs, and I will show how I'm buying these packs. Am I buying packs for new $10, or am I buying the beaten down packs which are trading at $4 5, which potentially can become penny stocks? So in this video, I want to talk about phenomena. So basically, a lot of these packs have hit highs in February, and since then they have been going down like crazy, down every week. So they go down like 4 5 days continuously, and then again they come up for a day or two and they go down. Okay, so whereas blue chip companies such as Apple, Microsoft, Google, Facebook, they have been hitting new highs almost every week or every month. Almost, I would say they are at new 52-week high right now, and in parallel with S&P. So why do we even take risk of investing in these SPACs when you could have invested in blue chip stocks? Okay, first of all, I do not believe anyone should have more than 2 to 5% of their portfolio in these SPACs. If you have that, then you are taking very high and speculative investor. Okay, so take an example, Astra Space. Okay, so Astra, symbol ASTR, which is a hot space SPAC play, which hit price of $22 within a week. That stock is now trading at $8. Okay, so similarly, Desktop Metal, which is supposed to be in a new generation 3D printing company, which has a lot of patents, great leadership, and which has hit $35 high, is now trading at $8. Excel Feed, Clover, Romeo Power hit almost $35, and now they are hitting at $6 and $7. Next, which I own actually, is Microvast, which recently merged with Tuscan Holdings, which hit a $25 high, now trading at $10 again. So, and even some specs such as Car Large, symbol LOTZ, so supposed to compete with Carvana, Shift, CarMax, actually is trading at $4. So I can go on, and but I don't think some of these packs hit bottom. Okay, so if you are thinking, oh, they have hit the bottom, let me buy more and average it out, that is like stupid idea. So I still feel they will go down another 20 to 30%, some of these, and they'll become $2 or $3 stocks before taking a long time or some time to come back. Okay, so what is happening? Why this phenomena in SPACs? Well, these are not SPACs anymore. These are post-merge SPAC companies, and that is what I want quickly cover in today's video. Okay, so when the SPACs announced the merger targets known as De-Spac process, such as let's take Desktop Metal. Okay, so everybody believed it will be really successful. Chamath actually hyped the stock so much, saying that most of the other existing 3D printing companies are legacy companies, and Desktop Metal is the future. Okay, so they hyped up, and the price hit almost $35. Even ARC owns millions of the stock in their 3D printing portfolio, but if you look at reality and quarter results, they are not that successful. They don't have a lot of sales. They don't have any revenue. So they are actually buying small companies so that actually they can show their revenue and they can meet the targets. Okay. So this is the reality that's happening. So basically they have been hyped. These companies have been hyped, and then what happened was a lot of pipe and hedge funds. For example, a lot of hedge funds deserted Desktop Metal. Okay, Bill Miller, who I follow, supposed to be a value investor, had large huge holding of Desktop Metal. they dumped like 30% of the desktop metal. Okay, so what happens is, so this is a long process. These companies may take 3 to 5 years before they actually make a lot of money or they show some growth and real revenues. Okay, so people are not ready to wait that long, and in general, there is a lot of these packs lied in their investor presentation. Large town motors, which they said, hey, we have lots of orders, but after merger they said they don't have money. So a lot of scenarios made these packs not believable, and then that's the reason why the whole sector, I wouldn't say every SPAC, a lot of the SPACs after post merger got sold off. Okay, so, and I believe, I think some of these companies dumped like crazy because of SPAC routes, even though the fundamentals are still good and the company itself doing good. Okay, example, so Microvast, which just merged with the Tuscan Holdings, I think it's worth more than $10. Let me tell you why. So they made $101 million in 2020 revenue, and they're expected to make, which is going great by the way, 2021, $230 million revenue in 2021, which is 128% growth. And at this growth, they are expected to hit a revenue of $2.5 billion by 2025 at an average 85% growth every year. Okay, so yes, it are looking good, but why did the stock went down by like 50-70% from high? Okay, so the reason is these projections are next 3 to 5 years. Okay, so if pipe investors or retail investors made like 20-30% on Tuscan, they're not going to wait for 5 years to get the results, right? So they take the money, they jump on to next company. So that's exactly what's happening. So the opportunity cost and the risk associated with the potential future execution of the strategy, that is what this company. So the SPAC in general has becoming a pump and dump ground. Okay, so the reality is kicking in. Priced, a lot of these companies don't have earnings, so obviously price to sales. Okay, so if they are saying, hey, if price to sales is 20 or 30 or 40, if you are above this range, down. Okay, that is how the stocks are being dumped. Okay, again, as I said, these stocks, I don't think they have hit bottom. Okay, so, and as I said, you should not have more than 2 to 5% of in your portfolio in these speculative stocks. Okay, so, and even if you have these SPACs, let's assume a new SPAC is coming. Okay, so do you want to buy that at $10, or do you want to buy a SPAC which is really beaten down, which is down by 70-80% from the peak price, or even 30-40% from actual IPO price, which is $10? Okay, so I would choose option 2. Okay, multiple reasons. Okay, so take for example Astra Space. Yes, I can see there is no revenue, a lot of risk, but in the space market, which they make cheap rockets and they have a lot of launches coming in. Okay, so their price was $22 just a few weeks back, and now at $8. Okay, so the way you can trade is you can still take some of the risks. For example, Astra. So I can buy Astra at $8 and then hedge them, which means I can sell covered calls at $15, which I'm talking about the strike price, strike target of like January, February, which is like 5-6 months. So if Astra, the space launches, shuttle launches are successful next couple of months, the stock price goes up, then $8 plus $2 premium and $15 stock price, you are getting 100% potential. Okay, so 100% growth in 5 to 6 months. Whereas if you are still conservative, you don't want to take chances, the way you can do is you can sell January, February puts for $7.50, close to get $2 or $2.50, which means Even Astra stocks goes down, you are getting the stock at $5 effectively. And if Astra stocks above $7, then you have 30% profit already. You made it in 5-6 months. Okay, so I do not buying options in these SPACs because they are too risky. So if you buy options in Astra, for example, and if stock doesn't go more than $10, you bought options for $15, all the money is gone. At least end of the day, when you have stock of Astra, you have actually some stock. You can do covered calls and hope that it'll come back at some point. Okay, that is how I invest. I'm very conservative, as I said. So I look at how I cannot lose 100% of my money. Okay, so that is what Astra is. And also, you cannot apply the strategy like every SPAC. Okay, some of them are like, I wouldn't buy a large sound motor today. I wouldn't buy Clover Health today. I wouldn't even touch a lot of these speculative stocks. Yes, these are meme stocks. They can go up or down, but I don't care. I want the SPACs who is making a lot of money right now, or the SPACs which are in a sector, for example, air taxis, right? So that is the sector I believe in. A space sector I believe in for a long term. Okay, so if you believe in air taxis, Blade, Atlas Crest, which are still cheap, like trading at $8, $9, and you can still get covered calls like 20 to premium. So long term, they will make a lot of money. Okay, space again, and EV batteries, Microvast. As I said, like Microvast makes a lot of money. So I could get $9, $10 Microvast. I can sell covered calls for 20-30% premium. Okay, so long term, I want to invest in EV space, and these are the sectors I believe in. Either you should be making a lot of money, or it is a growth sector. Even if you don't make any money, real great founders are there. Look at the still fund hedge funds which are not dumping, and look at the price targets. Okay, some of these, they are just become actually IPOs. So they don't have any unlist price targets. So keep an eye. Okay, keep an eye for this new unlist price targets for the companies to go. And since they became new IPOs, so you will see unlist covering these stocks. Okay, and setting the price targets. So that is what you need to keep an eye. Okay, so again, next time when you buy a $10 pack, ask again, where is the money? Okay, so in their investor presentation, are they just showing they don't have any money, but they have a great product, but for next 5 years they don't make any money? Think twice. Okay, so there are much better beaten down SPACs which are trading 50, 60, 70% below their ranges, which have a lot more safer and lot more potential to go up than buying a $10 or $12 pack and waiting for it to go down by 50%. Okay, so personally, I'm invested in SPACs. Okay, and this is exactly the strategy I'm buying. I'm looking for beaten down SPACs at $4, $5, $6 rather than buying SPACs at $30, $40. Don't get me wrong. Not every SPAC is like that. Okay, I am still invested in STEM, which I posted multiple videos. Still invested in ChargePoint. Still invested in MP. Some of them I won. Certainly I won, and I hedged them again. I had covered calls in most of them. So I still believe them. They are trading well above their IPO range. Some of them are trading $20, $30. Okay, so I'm not completely against the SPACs, but before buying a new SPACs, which have no revenue, no earnings next couple of 3-4 years, look into other SPACs. Okay, so which has a lot of potential, which are beaten down. Okay, so that is where I think you'll make more money than actually buying SPACs at $10. Okay, so this is the summary I want to talk about in this video, and this is why the SPACs have been going down. Okay, so my next video I want to talk about CCIV, which just merged with Lucid Motors. I own a lot of Lucid stock. I would like to talk about the price target for it in my next short video. Please wait for that video. Lucid is going to trade from tomorrow, and I have very interesting news to talk about that. Thank you. Have a great day. And before you leave, please click the like button. Please subscribe. And again, this is not investment advice, and this is purely for education purposes and just telling you how I am trading the SPACs right now. Thank you.